Good morning, everyone. My name is Arash Adnani from privateplacements.com. We have an expert panel with us today. Joining us is Lyn Alden, founder of Lyn Alden Investment Strategy, an investment research service for retail and institutional investors. You can find her work at lynalden.com. We have Rick Rule, founder of Rule Investment Media, ruleinvestmentmedia.com, former president and CEO of Sprott US. Legendary speculator and investor. Rick, good to see you again. Lyn, thank you for joining. Our timing is great for this. Just a couple hours ago, the US job numbers came out and it beat expectations for 467,000 jobs added. Lyn, let's start with you and let's start with the macro. What big trends are you seeing in the markets right now, especially post these numbers being published, and what are you anticipating from here on out?
So one challenge with the numbers is that this is a report where they did years worth of revisions. They do that every once in a while, kind of like a big reconciliation of their books, so to speak. And so, if you look at the unadjusted numbers, the non-seasonally adjusted numbers, just like every January, they go down by millions of jobs. Basically, all the Christmas holiday stuff rolls off, and so you have this big downwick in terms of the number of jobs. And it was no different than any other year in that regard. Basically, nothing remarkable from the unadjusted numbers. Whereas the adjusted numbers, because there's all these reconciliations, there's a lot more signal than noise. So the market's reacting to a very unusual jobs report. But I think under the surface, it's less remarkable than it seems. I think the broader context is that with inflation running at, in the US 7%, we're getting inflation in Europe that's very high. And basically, central banks are the furthest behind the curve on inflation that they've been for decades. So, if the United States, the last time rates were this far below CPI was like 1951, and so you have to go back a very far ways to find that. On the other hand, the problem that some of these central banks are facing is that purchasing managers' indices and other indicators of the economy are actually rolling over. They're softening. So that's not necessarily saying a recession's on the horizon. It just means that a soft patch seems to be on the horizon. And so if you look at various leading indicators, various strength, measures of whether the economy is accelerating or decelerating, they generally indicate decelerating, still positive growth, but just less growth than we had after kind of a sugar high last year. And so I think that's a challenging market for a lot of risk assets, especially growth oriented assets. But I think that the biggest structure overall is that I'm still bullish on commodities and inflation for this decade, even though I think we're, in terms of inflation, we're probably heading towards a softer patch after a very strong upward rise over the past year.
So let me ask you this, and Rick, I want to get your feedback on this as well. There's a lot of metrics and KPIs, and a lot of them just seem to be, somewhat misleading and just noise. If we were to look at something as far as a true number, a true metric to look at, what is a better number for you? Because and by the way, just to preface that, when I saw the U.S. numbers, I live in Vancouver in Canada. I checked the numbers in Canada, and the numbers actually dropped by 200,000. But also read that it doesn't cover the entire month of January. It's just about half of the month. I don't know what the U.S. numbers are, if it's the full month or not. And that just kind of made me think, like, okay, well, that's not even a true indicator. It's missing a good chunk. What would you recommend people, which numbers to maybe focus on and which ones to ignore? Because you also hear with inflation, it's a lot higher than 7%, but we're just getting the 7% print so people don't freak out.
Yeah, so I think the PMIs are really key to watch because they give you a really good rate of change of what's going, and they give you kind of some advance notice. They generally are, if you generally have a more risk off type of portfolio when you have a declining PMI, and you have a risk on portfolio when you have a rising PMI, that tends to, to work fairly well. And of course, that means different things for different investors. That can include raising cash if you seem to be kind of at a peak level, and maybe that's rolling over, and it can include getting a little bit more aggressive when you start to have low sentiment, and yet PMIs are kind of bottoming out and rolling back up. And so I think that's key to watch. I think as far as CPI numbers, I do think they understate it, especially in the home segment. So for example, homes are in many zip codes in the US up double-digit percent year over year, but they just include kind of this wonky, owner's equivalent rent figure in that place. And so I like to break apart different CPI aspects. So we still have those home figures, the rent and the owner's equivalent rent, that's still rolling up with a lag compared to what we saw with actual rents and owners and actual home prices. But we did see in some advanced data, rent levels have kind of peaked out in a number of markets. Kind of that stimulus surge has kind of got into the rents already. And we also see that home prices in many areas have peaked and kind of started to soften. And so I think with a couple month lag or several month lag, we'll eventually see those CPI equivalents start to peak out. And then you look at base effects, kind of the month over month base effects. I think by quarter 2, we'll see, probably top out in terms of the headline year over year CPI figure and start to head down for a period of time. But I still think that it's going to be basically a disinflationary period within a broader inflationary trend. I think, the whole disinflationary period of the last 5 to 10 years of commodity oversupply, especially energy oversupply, is more behind us than in front of us. And I think that going forward, a lot of commodity markets are tighter, and that a lot of central banks have an inability to get back to structurally positive real yields because of how much debt is in the system. So they have limited capacity to fight that inflation.
Rick, what's your thoughts on that? And just again, just general kind of trends in the markets as far as where we are so far this year. Any surprises?
I think you just heard the best possible answer to that question that I've heard in the last 4 weeks. So I won't compete with it. I'll just add a couple of notes, I suspect. With regards to jobs, I follow an interesting pundit named Mike Rowe, who points out that there's 6 million unfilled jobs in the United States. There's a tremendous mismatch in the United States between what the labor market wants and what the labor force is able to supply. Decades of miseducation, a sort of downplay of trade and technical skills. And I think that an understanding of the jobs market should go to a macro person like Lyn, who can talk about the mismatch between what the economy wants and what the population is able to supply. On the CPI, again, I would defer. I went through the period of the 60s and 70s. I went through the period, the last lag with negative real interest rates and high CPI numbers and a sort of a population malaise responding to it. I would say with the CPI that the people who compile it don't seem to shop where I shop. And I don't buy much, but the basket of goods and services that they consume is completely inconsistent, I think, with the basket of goods and services that I would consume. And the other thing that I would point out to everybody is that when you're figuring out your cost of living, the fact that the index doesn't include tax seems fairly odd to me. I guess if I didn't have to pay the tax, I wouldn't bitch so much about the index. But as Lyn says, in many senses, it's a specious number. It's useful as a factoid. It's something that people focus on. But in order to really truly understand either the jobs number or the CPI number, you have to do what Lyn does and unpack it. So it's a very complex question.
So let me ask you this. I agree with you when you say, the officials aren't shopping where I'm shopping, because, I see the same things. I see numbers being in double digits easily across the board on many things, on many goods. And we're talking about this earlier before everyone came on. There's a lot of noise, right? If you're an investor and you're signed up to new newsletters, Twitter, every day there's new numbers being published. From your standpoint, what's a good strategy to get away from the day-to-day, let's say, distractions and noise, and kind of start taking more of a long-term? Now, when I said long-term, I'm not talking about years on out. I'm talking about maybe months on out and revisiting the strategy. Rick, maybe let's start with you. What do you think is a better framework for that sort of approach instead of the day-to-day knee-jerk reaction sort of strategy? And then Lyn, I'd like to get your feedback as well.
I'm glad you framed it that way. My short-term economic forecasting track record in 40 years is unblemished by success. So I pay no attention at all to my own near-term prejudices. But my work involves very much around supply and demand. I look in particular for commodities where the worldwide price that consumers pay for the commodity is less than the total cost of production, which is to say a commodity where the industry is in liquidation and where either the price has to go up or that commodity becomes unavailable to humankind. If you, as an example, look back to the COVID-induced oil price decline, maybe COVID and Greta-induced oil price decline, the International Energy Agency will tell you that the fully loaded cost to produce a barrel of oil worldwide, not the lifting cost, but the fully loaded cost is somewhere between $50 and $60 a barrel. When the stuff was produced, was being sold for $20 a barrel, the industry was losing $40 a barrel, and they were losing it 90 million times a day. Boring first and then painful. It was very clear to me that one of two outcomes was going to happen. One, the price of oil would go up to the incentive price of production, or two, my car wouldn't start. And in a fairly short period of time, 3 or 4 years, thinking it likely that my car would start, it was a pretty easy decision for me to go into the oil stocks because they were priced as though oil was going to stay at $20, when clearly, given the utility of oil to consumers worldwide was high enough that the oil price had to go up. So my own work, partially, frankly, because of my inability to sort through the data with regards to short-term macroeconomic forecasting, focuses very much on supply and demand. Note too that I'm not a general market investor. You won't find me commentating on technology stocks, businesses that I can't spell or pronounce. You won't find me commenting on marijuana stocks. The last firsthand due diligence I did on that subject was 45 years ago. I focus myself on natural resources, and I focus on long-term supply, long-term demand, and I focus on company micro, which is to say companies that do things better than other companies in the same space. So I would defer to Lyn on virtually all matters in terms of those numbers that you described.
Lyn, what's your thoughts on that? Does the supply demand kind of thesis match with what you do, or do you have a different way of looking at things, especially when it comes to commodities? I mean, we're going to talk to commodities a lot, but how do you look at and framework your approach?
I probably divide it into two different time frames. So on one hand, I look at, like I mentioned before, the PMIs. Those tend to be about 3-year cycles. And so that I would consider that kind of intermediate term. You generally get weekly or monthly updates on things like that. And so, for example, there are leading indicators that come out weekly that are similar to PMIs that you can kind of track along with them. And those are useful data points, I think, to manage expectations over, say, the next year, the next 2 years, if it's rising or falling, and what the leading indicators suggest is that's going to be the forward momentum on that. Whereas, longer term, I like to buy things and hold them for 5 years or more, like these longer term compounders. And so when I look at commodities, for example, I take a similar approach to Rick, where I look at, is this below the cost of production? What's going on with CapEx? How cheap are the securities in the space? And I think the big difference is that because I don't have the micro expertise, I don't go into the smaller players. I don't differentiate between some of the smallest companies. And instead, I make a bigger view on what is the commodity likely going to do, and then how can I get some exposure to some of the higher quality large and mid caps in the space. And so I think that's my biggest difference. And I think one of the biggest things that economists mess up is they don't look at the natural resource capex cycle. Basically, there's this big ongoing 10 to 15-year cycle that they go through, and economists don't really focus on that. A lot of it's more demand side type models. And so they seem to get blindsided by these periods of inflation because they have so much recency bias. We've been in, say, a disinflationary period. We've been in this, period where, say, oil's oversupplied. It's only held back by kind of voluntarily cuts to production. And they kind of just extrapolate that as though it's going to last forever. And I think that basically, if you come from a macro standpoint, actually pay attention to the commodity cycle, that alone gives you a big advantage over the vast majority of macro forecasters out there.
Okay, so if we're getting into commodities, oil's been holding strong at $90. There was a slight pullback, and I think ARK Investments came out and was talking about is the end of oil. Electric vehicles are taking over, and boom, we're back to 90, and now natural gas shortage, and again, back to the kind of the news cycle we were going through a few months ago. Is this oil kind of is $90 oil kind of like $1,800 gold? Is it anchoring around here, or does that have room for growth? Are we going up from here? And this is, I guess, part of the supply demand thing we're talking about. Rick, do you want to get us going on this?
Sure, and I think it depends on your time frame. If you continue to see the purchasing power of the dollar decline at 6 or 7% compounded, the price of oil can go up under its own volition. Looking longer term, I think you need to direct a question to Lyn as to whether we'll see on a global basis a synchronized recession or depression. because on the supply side, oil supplies, despite the fairly high real price for oil, are declining. The industry is deferring about $1 billion a day in sustaining capital and new project investment, which is to say, despite their very, very, very high free cash flows, they're returning that cash flow to the shareholders rather than using that cash flow to maintain supplies. So almost irrespective of what we do, other than increasing investment by $360 billion a year in the oil business, the supplies will decline. Demand is not declining, despite the wishes of the big thinkers. It's interesting that the big thinkers flew 520 at last count private jets to Davos to tell you and I to drive less. But the trend that they talk about is a trend that seems to be happening worldwide. I think that the world will demand more of all forms of energy. Hydro, to be sure, wind, to be sure, solar, to be sure, but oil and gas too. If you do like I do, Arash, which has traveled to a lot of frontier and emerging markets looking at natural resource producing properties, what you see is, as an example, a distinct shortage of charging stations for Tesla in places like Malawi that don't have very many paved roads. In markets like that, the growth is from barefoot to shoes, from shoes to bicycles, from bicycles to 50cc motorcycles, and from 50cc motorcycles to Toyota Hilux. I suspect that peak oil demand will occur sometime around 2040. And the supply shortfalls that we're going to have as a consequence of both falling, sustaining, and new project capital investments, and also increased social rents and permitting, means that supply shortages in the oil and gas business are almost inevitable.
I view it similarly, and one, a lot of that growth is going to come from emerging markets. And so China, for example, they have, their building boom has likely peaked, right? The rate of change that they're putting up these skyscrapers has likely peaked, but they still consume a small fraction of the oil per capita as a developed world. And then when you go downstream from there, so India consumes a small fraction of what China consumes. And so I think those are still structural growth drivers, other emerging markets as well. And another factor is, in some ways, that's even overstated because over the past 25 years, the United States and other countries have outsourced a lot of their production to China. And so some of China's per capita consumption is really American consumption. It's basically going back to Americans. It's making our products. And so, a lot of these developed countries, they talk about how they've kind of flatlined their fossil fuel usage. But we actually just kind of did this accounting trick. We basically pushed that onto another country's balance sheet. We outsource some of our production, and so it's on their balance sheet and comes back to us. And so if you look at end demand, China's even lower than those numbers. And I think over the next couple of decades, China's going to slowly transition from a production-oriented economy towards a more balanced or consumer-oriented economy. And I think that's going to be a driver. Same thing for India. And so combined with how tight the supply side is, which again, most economists don't focus on, they focus heavily on the demand side, very little on the supply side. I'm favorable long-term. Now, when we have such a strong rise in price and everyone's talking about it, and it gets on CNBC, my kind of contrarian alarm bell goes off a little bit. And so I start to maybe expect, disappointments over, say, a 6-month period or something like that. So I maybe pound the table a little bit less on the trade. But I think if you zoom out, if you look at the S&P 500, the percentage of the market cap that is in the energy space, that had an all-time low of like 2% in 2020. It's risen up to like 3%. It's still a structurally small percentage. I think when we look back at the end of this decade, that will have risen considerably as a percentage. I don't know if it'll go back up to prior highs, but I don't think it'll stay around 3%. I think we'll be above 5%, maybe higher single-digit percentage. And also, they usually pay higher dividends along the way, at least the large caps and some of the energy infrastructure companies. And so even if that trends sideways, you're getting paid a better yield along the way than the broader S&P 500. And then when you look out at emerging markets, you can get some cheaper ones if you're willing to take on more risk and volatility and jurisdictional risk. And so I'm still bullish on the commodity itself and most of the quality producers long term.
Okay, so you're both bullish long term, but right now, given that it's mainstream media and maybe a little too hyped up, maybe you're not exactly going in right now. Is that fair to say?
I'm still holding. I'm just, I'm kind of managing
Not
expectations.
topping off.
Yeah.
Okay. Let's talk about another an energy metal, clean energy. So, Rick, we've talked about uranium a lot in the past. Lyn, you've followed uranium quite extensively as well. Last year, starting in July, August, Sprott launched its physical uranium trust, and it was just, all of a sudden everyone came out. Everyone had a uranium project. Everyone was investing in uranium. It was runs. The stocks were flying. It's come back down to earth. There's been maybe some money taken off the table, whatever it may be. What's the outlook this year for uranium spot price, and also what's your strategy from how you're constructing your portfolio with uranium in mind for 2022? Rick, let's start with you.
Well, a disclaimer. I've been through now 3 uranium bull markets, and the second one was probably, for me personally, the most profound financial event of my career. That run, which occurred 1998 to 2006. So let's get bias out of the way. Uranium is a perfect contrarian's topic because it punishes you severely and then rewards you immensely. But it actually gets better than that, because when you talk about uranium to an investment audience, they aren't merely bored by it, they're often hostile to it. I've had people basically attack me on the podium saying, you're a proponent of Hiroshima, Nagasaki, 3 Mile Island, Chernobyl, and Fukushima. And if you're a contrarian, the idea that you don't merely bore people, but they in fact hate you, is confirmation that you're in something cheap because people despise it. But the truth is that uranium is an indispensable part of our energy mix currently, and probably a more indispensable part of our energy mix going forward, given the fact that it can generate reliable, cheap baseload power. Many people don't realize that uranium, even today, provides 20% of the US baseload capacity and 14% of total electricity demand in the United States. And again, the arithmetic is like the previous oil example I gave you. The International Energy Agency suggests that the true incentive price to produce a pound of uranium is probably at $60 and probably increasing because of supply chain inflation and also because of increased social rents and permitting time. So the industry makes the stuff for $60, they sell it for $45 and lose $15 a pound. Similar story. The price has to go up, but can the price go up? And here the answer is yes, too. The fuel bill for a nuclear power plant is probably 5% of the total cost to produce a kilowatt of electricity, meaning that the uranium price would double, and it wouldn't be anywhere near as important as the lawyers' bills or the lobbyists' bills. If the price of something can go up and has to go up, it will go up. I suspect that 3 years from now, the incentive price to produce uranium will be $70 or $75 a pound. And I fully suspect that within the 3 to 5 year time frame, that the price of uranium must escalate to the incentive price to produce. The backdrop that we have against this, the tightening time frames and the more certainty with regards to result, has been greeted by a 45% decline in the equity index around uranium, which is to say, as the outlook became shorter and the time frames became shorter, the hot money left the uranium space to go somewhere else. So I see these stocks as being very reasonably priced. And I think there's 2 catalysts in the market. One, post-Fukushima, the spot market was grievously oversupplied with uranium because the Japanese reactors got turned off and all that inventory went from held to processed to held for sale. But 5 years passed, a lot of that got used. There were production cuts. And importantly, the Sprott Physical Uranium Trust came in and took 40-something million pounds off the market. In other words, that supply went to supply heaven. More importantly, actually, I hate to say this as a Sprott shareholder, but more importantly, the winds of political change have changed the outlook in Japan, where now 18 of their largest plants are in permitting for restart. These are not like the Chinese plants that have to be financed and built. They aren't going to impact demand 10 years from now. They're going to impact demand in 2022. So I suspect now that 2022 is the point of change for the price of uranium. And mercifully for me, the uranium equities have declined in price to levels that I think are attractive. I'm I'm really attracted to the sector. Could there be a 20% decline from here in the equities indexes? Sure. I juxtapose a potential 20 or 25% decline, which could happen, against what I see as a 200 or 300% increase in the indexes, and larger increases in certain select stocks. And when I look at the 2, 3, 4, 5 year juxtaposition between 25% downside and 300% upside, given the certainty of the thesis, it looks very attractive to me.
Well, you've timed it perfectly, because last time we talked, it was at the equities' highs, and you told us very, very frankly that you were out. You'd already taken money off the table, and you'll come back in when it's cheaper. And now it's cheaper, and you must be happy. And maybe a good time to quickly plug the boot camp coming up, Rick.
Well, thank you for that opportunity, Arash. I'm certain enough of this thesis and well enough connected to the uranium community that I'm going to have a 6.5-hour online uranium boot camp, March 19th. We'll have leading uranium traders. We'll have senior officials with Cameco, Kazatomprom, which is the largest uranium producer in the world, China General Nuclear, talking about the Chinese uranium market. We think it's basically everything that an investor and speculator needs to know in 6.5 hours. $99 to attend. If you're not satisfied, 100% money back guarantee. If you don't think it was worth your money or your 6 hours, I can't give you back your 6 hours, but I'll certainly give you back your $99. I'm unhumble enough to suggest that if you are or intend to be an investor in the uranium or uranium equity space, that this is a must-attend event.
It really sounds like a boot camp / masterclass on uranium. Lyn, your thoughts, and what do you see as upcoming catalysts? Because with the commodities market, you need the catalyst, and the last catalyst for uranium was Sprott coming in and just buying up physical uranium. What do you think's needed this year to kind of wake things up again and get the equities going on the run again?
Yeah, that's my challenge in the intermediate term. Is I don't have a clear view about the next 6 months or so. Rick mentioned Japanese catalysts. I started to get bullish in the space back in 2020, in part because of seeing Rick talk about it. Basically, seeing experts put that on my radar. Because before then, I wasn't really on my radar, and then it started to get on my radar in say 2018, 2019. I really did the deep dive in 2020. And so I've been structurally bullish since then, for all the reasons Rick just described. And once we, after Sprott came in, that was another catalyst. And once we started to see that the premium to NAV went away, and it was a somewhat more balanced situation, and that catalyst, at least the initial part of that catalyst was behind us, I became more near-term neutral, but still maintain that position in my portfolio because it's so uncorrelated with my other assets. Basically, the nuclear industry is going to do what the nuclear industry is going to do, regardless, pretty much of what happens with my other investments. And so I kind of maintain it as an indirect, you can call it like a short dollar position. I think that, with inflationary pressures, the cost of producing uranium is going to keep going up. I think over the long run, the price is going to go up to a structurally positive, profitable level. And so I'm maintaining that position long term and not really focusing on it too much in any sort of 6-month time period.
Okay, so listen. Naturally, we've talked about uranium, and I think we're all very bullish on uranium. So I think it's only right, as a nice treat to everyone that's joining us right now live, is maybe you guys can each give us a couple of companies you like, or how you are positioning uranium into your portfolio. There's different products. Lyn, what do you like as far as exposure to uranium right now?
So my answer won't be as interesting as Rick because I don't go down to the small cap analysis. I like the Sprott Physical Uranium Trust because you can have a larger position size in something like that because it's less tail risk to the downside. And then I like owning some of the indices or the diversified plays. And I leave the individual stock analysis more to Rick and other experts.
Rick, take us down the uranium rabbit hole.
Well, I would start the portfolio exactly the way that Lyn suggested. If you think uranium's going up, the first thing you do is buy uranium. This isn't like gold or silver. You don't want to throw it in the basement. The only feasible way to buy uranium as a North American investor is to buy the spot physical uranium trust. And the headline number is pretty good. I mean, the stuff's selling for $43, $44 a pound. I think it's going to 70 minimally. It may overshoot, but I think it's going to go at least to the incentive price. So the idea that you could go from 45 to 70 in a reasonable period of time is attractive in and of itself. I think that the large caps are actually more attractive risk to reward right now than the small caps are. And so I would move some money from allocate additional money, starting with Kazatomprom, the best, biggest uranium producer in the world, selling off very hard because of political events in Kazakhstan. So you do take some political risk there, but with uranium, you can take political risks everywhere. Kazatomprom is simply the 800-pound gorilla in the uranium space. I think you need to own Cameco, the big Canadian producer, because it's a bellwether for uranium prices. Coming down into the juniors, and it's interesting that this call is being hosted by privateplacement.com. A lot of junior uranium producers held off raising much needed equity. And I think they played chicken with the uranium market and they lost. They're going to need to raise equity in 2022. And I think, I could easily be wrong on this, but I think 2022 will be the best year for junior uranium private placements, probably in a decade. I think you'll see supply. That is, I think you'll see companies needing to raise money. I think the time frames that they have to deploy it will be shorter. The catalysts are in place. So I would be looking opportunistically. I note that our database now has 71 junior uranium companies worldwide. The vast majority of these are pretenders. They have uranium as part of the name on a share certificate. The problem is that they don't really have any uranium. And I would caution speculators that if the price of uranium goes up and you buy shares in a company that doesn't have any uranium, it shouldn't have any real impact on the value, although it might have some impact on the price. There are probably 10 juniors, 12 juniors worldwide out of a universe of 70 that are worth buying. And that isn't information that I'll give away for free, but it's information I'll disclose piecemeal, heavy water torture, so to speak, over time. But certainly the strategy that Lyn talked about, which is to say, first of all, a Sprott Physical Uranium Trust, and then in descending order, Kazatomprom, Cameco, and China General Nuclear Mining would be top picks of mine.
Excellent. So let's talk about the other yellow metal. Lyn, your thoughts on gold? I mean, listen, with interest rates going back up and going back to normalcy and all that, is the party over for gold, or is it just starting? What's happening?
So I think the near term, the fact that the Fed is looking to raise rates puts some, at least some sentiment challenge on gold. But I think going back longer term, if you chart out federal debt as a percentage of GDP, and then you chart out, say, real rates, so rates minus CPI, let's call it, you'll notice that whenever debt is this high, those rates pretty much have to be negative. There's almost no way to make the math work otherwise. Emerging markets default on their bonds nominally, and developed markets default on their bonds through inflation, more or less. And so whether or not you look at the ECB, you look at the Fed, you look at the Bank of Japan, their sovereign, their country's sovereign debt levels are so high that their central banks are rather challenged in terms of being able to normalize rates, even though they can raise rates. There's a difference between raising rates and actually normalizing them to positive structural real levels. And so I think that gold is interesting here, especially given the softening economic data. So when you have 7% CPI and economic growth is doing great, people wondered why gold didn't do well last year. Well, so many stocks across the board were doing fantastic. You could buy stock indices and participate in the upside because you had inflation without high yields. That's a great environment for risk on assets. But when you have inflation and yet you also have a declining, a softening economic growth, that's a more attractive environment for gold, at least relative to other assets. And so I still like gold as part of a portfolio. physically held, and then also some of the producers as well, because kind of like what we're seeing in the oil industry, a lot of the gold producers are focusing on free cash flow and stronger balance sheets, and so actually some of their valuations are rather attractive, and so even just from a value investor standpoint, some of them are interesting, and so I still like gold and gold miners as part of a portfolio here, and we've seen kind of interesting resilience out of gold over the past few months. It's kind of formed this rather, kind of sideways structural pattern that I think is pretty favorable. And I wouldn't be surprised to see this turn into a big cup and handle pattern where you had the big peak in 2011, 2012, rolled down, rolled back up, hit a slightly higher high, and then it kind of had this, this smaller correction, this flatlining. I wouldn't be surprised to see that eventually curl back up and go to new highs. And so it's obviously a very difficult market to forecast, but I'm favorable on it.
So Lyn, a follow-up question for you, and I've been really excited to ask you this and get your feedback on it. Do you think part of the reason why gold is maybe not moving as fast or as aggressively is because really what Bitcoin is doing as far as stealing away some of that love, attention, and capital that would normally go towards gold as kind of the alternative to a, let's say, safe asset against inflation? Do you think that's what's happening, or is that argument really a non-issue?
So prior to 2021, I would have not really viewed it that way, but I think 2021, basically Bitcoin got big enough and popular enough that it actually is a meaningful percentage of the market cap of gold, especially the retail and kind of private, institutional kind of adoption. If you exclude all the central bank holdings and you exclude, the jewelry, if you actually just look at private investment demand, Bitcoin became a pretty meaningful chunk of gold's size. And then also if you look at fund flows, you can see a pretty strong inverse correlation over the past 2 years or so, where when money was flowing into Bitcoin, it was kind of flowing out of some of the gold products that are out there. And so I do think that we can consider it basically a form of market share competition. If you were a company that had a monopoly, or maybe you had a duopoly with silver, right? And then a third entrant or a fourth entrant comes in and splits that pie, that can divert some of the fund flows. And so I think it's something to watch, kind of like how with gold you have to watch multiple variables. You have to watch real interest rates, you have to watch the dollar, you have to watch economic acceleration or deceleration. I think Bitcoin is now another variable that is worth watching because it's self-custodied, scarce money in a way, right? So it obviously has some similarities. One thing I'd point out is that historically Bitcoin's biggest bull runs were during rising PMI environments. So 2020, 2017, 2013, these were these really big move ups in Bitcoin. And so it's what differentiates it from gold is that it generally trades like more of a risk on asset than gold. And so I think gold still has an advantage in a more defensive type of environment, a softer economic environment.
Okay, so 2 questions. One's for Lyn, and then the second one is a request for Lyn. I want you to do something for Rick. So question number 1, can you explain the recent volatility in Bitcoin? Because it's been nasty. So that's question number 1. Just give us feedback on that. Request number 1, after question number 1, can you pitch Rick on why he should own, or at least consider owning Bitcoin?
For the
volatility.
Yes. So basically, Bitcoin and cryptos in general have been extremely volatile since their inception. Basically, anything that goes from 0 to $1 trillion market cap in 12 years is going to be volatile along the way. So basically, the market is kind of determining this thing's total addressable market, and it's a big unknown question. And so as it monetizes and becomes, first, in the early beginning, it was peer-to-peer traded. Then the early exchanges came. Many of them couldn't get banking relationships, and so you had kind of and you had the Silk Road days where people could use it to buy drugs online. Then after that era, you had the more regulated exchanges. You had exchanges with actual bank connections, and then in this cycle, you had building up with the past few years, you had institutional custodians came into the space. So Fidelity, NYDIG, more serious kind of institutional grade custodians. And so now we see insurance companies own over $1 billion worth of Bitcoin. So some of the largest, for them, it's a very tiny position as a diversifier. But basically, you have these 150-year-old, trillion-dollar portfolios that own a non-zero Bitcoin allocation. We also see that investment banks got into it, custodian banks, like Bank of New York Mellon. So it's kind of been the year of institutional adoption. Hedge funds get in, and so as we've seen PMIs roll over, we've seen a lot of the turbulence in the crypto and Bitcoin space. If you look at, say, ARK, right? So those unprofitable hyper growth stocks, they peaked back in February 2021, and they've been in this, nearly year-long correction. And you've actually seen kind of similar activity out of Bitcoin. Basically, the demand for Bitcoin peaked back in the first quarter of 2021, and ever since then, Bitcoin it's held up better than ARK. It's been in this kind of sideways, choppy consolidation period, whereas ARK is just continually bled out to lower lows, whereas Bitcoin managed to hit a higher high later that year, even though it actually had weaker demand then. Basically, the supply side was so tight. And so one way I would phrase it right now is that if you look at the supply side of Bitcoin, obviously we know that the hard cap is 21 million, but you can also look at on-chain analysis, and you can see what percentage of coins are held by newer, faster money versus coins that are held by longer, less liquid money that pretty much wants to take it off the market and send it to supply heaven. And over this past year, you've seen a rotation. Fast money got out of the space, people bought the top and then sold at a loss, kind of that cycled back into the stronger hands. And so the supply side has been very favorable, but there's just been a lack of new demand coming into the space, which is normal when you have a softening PMI environment. So leading indicators of economic growth pointing down, liquidity being somewhat drawn out of the market, or at least put into the market at a slower pace than it was before. And so it tends to be kind of a leading indicator of what you eventually see out of the stock market. If you see a lot of softness in Bitcoin, ironically, it's kind of a canary in the coal mine for what you might see out of the S&P 500. And we've kind of seen that play out, I think. If I were to make...
Sorry, go ahead.
Oh, and if I can say, if I were to make the case of why it's worth owning Bitcoin, I would say essentially that it's a self-custody form of money. And my concern early on was that anyone can make a new crypto, right? So even though Bitcoin is scarce, anyone can make a new one. And the way I would describe that is network effects, right? So Bitcoin has the most energy backing it up. It's the hardest one to do an attack on. It would take billions of dollars to even attempt a credible 51% attack on Bitcoin. And so I would describe it in a similar way that I would describe anyone can make a new Wikipedia, but they can't really do it, right? So it's kind of like you can make your own wiki, and the question is, can you replicate the fact that there are millions of links around the world pointing to the real Wikipedia, that all the people that are on it updating all the time are on the real Wikipedia? It's hard to get them to shift over to your new Wikipedia. And so Bitcoin has this kind of network effect in terms of its security and its level of adoption and its level of decentralization that is very hard to repeat. It's kind of like how if a certain protocol takes over, like Ethernet or TCP/IP, it's very hard to dislodge that protocol unless you come and make something 10 times better. And so looking at basically the network effects of Bitcoin, I basically view it as this self-custody form of money that you can then also send to people permissionlessly around the world, which for people like me and you and Rick is not that important. We live in United States or Canada, we have good payment systems, we have rule of law. But if you look at most people around the world, they live in authoritarian regimes, more than half, or they live in places of double-digit inflation. Many of them are unbanked. And so Bitcoin actually represents a way for them to move around capital controls, to self-custody money, to basically have some defense against surveillance states and kind of draconian financial controls. And so in that sense, it's this stateless money that I think has a total addressable market that is probably larger than the current market cap.
Rick, is 2022 the year that you finally get into cryptos?
Well, I should tell you, this will subject me to a lot of ridicule. I had the extraordinary good fortune of being exposed to crypto at Freedom Fest many, many years ago at about $10. I wasn't smart enough to buy it at $10. I was, however, smart enough to run into Tika Tuara, who talked me into buying some at $200. It proceeded to go immediately from 200 to 500 or 600. And I thought, wait a minute, I just got a triple in something I can't pronounce or spell or understand. And I would be some kind of old fool not to take this triple. So I was smart enough to get in well sub 1,000. I was dumb enough to get out well sub 1,000. I'm at the stage in life where I choose to invest and speculate in things that I understand thoroughly and where I believe that I have a competitive moat around my knowledge, or where they are so thoroughly despised relative to their norms that I think they're cheap enough to overcome my ignorance. Bitcoin doesn't fulfill either of those for me. I'm a fairly substantial investor personally in distributed ledger and blockchain technologies that will affect conventional financial services, or that will affect the exchange, authentication, storage, and ownership of physical precious metals, which is to say, payment mechanisms or coins or tokens that are backed by physical gold and silver. As for Bitcoin, I understand exactly Lyn's suggestion that it is an alternative currency, and it's an alternative currency whose time has come in terms of even its volume and liquidity and its sort of distribution worldwide. Ironically, the volatility in Bitcoin that delivers traders reduces its utility as a medium of exchange. If you buy something with Bitcoin, you never know from day to day what you paid, and the merchant never knows from day to day what he or she received, because the volatility against the other currencies that we live our lives in is so extraordinary. I'm attracted to Bitcoin. I'm particularly attracted to Bitcoin in terms of the utility that it offers up people to live their lives more freely and not be captives of fiat financial systems. I'm not a Bitcoin investor because I don't have a durable competitive advantage over other investors, and it isn't despised enough for me to invest it on any other basis. It's interesting, Arash, when you talk about volatility. Speculators don't seem to mind or criticize or misunderstand volatility upside. One could say that in the span of 10 short years or something, that the price of Bitcoin has gone from $10 to 35,000. That's volatility, right? The adherents to Bitcoin don't talk too much about the upside volatility because it confirms their bias. They're concerned about the fact that it went from 65,000 or something like that down to 35,000. One of the things that I've learned in my life is that if you're really attracted to an asset class, you love declines. If you want to buy more Bitcoin, why would you prefer to pay up? Why would you prefer to pay 65,000 when you could get it for 35,000? It seems, however, that as Lyn described recency bias, that people's expectation of the future is set by their experience in the immediate past. And that people who profess to love Bitcoin might be like people who profess to love gold, fair weather friends. They love it when it goes up and they don't like it when it goes down. A measure of true love would be if you doubled your position when the price fell by half. But that seems to be a test that's too tough for investors and speculators in most asset classes worldwide.
Yeah, and that applies to all asset classes. And that was, we're going to pivot from Bitcoin, but that was one of the most level-headed arguments for and really just overview of the market by you both. So thanks. Normally on Twitter or anywhere else, people are just yelling at each other on Bitcoin for or against. So thank you for that. Rick, we're going to stay with you because we were going with Lyn for a while there. I want to give her a bit of a rest. What are some other unloved, not stocks, but commodities, unloved ones? So, you know, gold always gets the headlines, uranium's getting headlines. Who are some commodities in the shadows waiting to come out?
I think if you can stomach thin markets, that is to say, if you're a real speculator, vanadium has all kinds of utility. It's been priced below the total cost of production for many, many, many years. I would caution people, however, that it's a very, very, very thin market. The most unloved commodity sector isn't a commodity, but rather it's a place. If you're a commodity investor and you don't invest in Russia, you aren't actually a commodity producer, because Russia is a very large and low-cost producer. And the current political and social difficulties in Russia has made the world's cheapest commodity market cheaper still. If somebody really styles themselves to be a contrarian, and they don't own, Lukoil, Gazprom, Polymetal, Polyrus, Norilsk, they don't own the best mining and oil and gas companies in the world at once in a decade sales. That doesn't mean that if the Russians come across the border into the Ukraine or involve themselves in some other adventure, that they won't get cheaper still. But if you're looking for a commodity related sector that is dirt cheap and high quality, I think that you need to look to Russia. Investors in the United States who are very sophisticated investors should probably look where they're available at private water rights. The most undervalued commodity in the United States by a country mile is water, because water is allocated politically and not by market, which means water flows uphill to votes rather than downhill to money, downhill to utility. And the arbitrage between a good that's artificially available as a consequence of subsidy and a commodity that is as valuable as water is the ultimate arbitrage. It's something I've been doing for 35 years. We have this weird circumstance in the United States where the allocation of water is determined politically rather than by markets. So we do things like grow rice and alfalfa in the desert, requiring vast amounts of water to produce very little economic utility. And the resolution, the economic resolution of pricing water to utility and accommodating supply and demand by utility rather than by political popularity, will probably be the greatest and perhaps the most vicious economic reset that the commodities business in the United States has ever seen.
Well, I think one trip outside of North America and closer to maybe Asia and parts where water isn't so freely available, it makes you realize how when people say water's blue gold, it's serious, and it's always overlooked when you're, I'm in Vancouver, water is never an issue here, but that's not the case for everywhere else in the world. Lyn, what are your thoughts on some unloved commodities that you think people should pay more attention to?
So I'm watching the copper market to some extent because I got in on that back in 2020, and it went up faster than I would have guessed, and it became very consensus. And so I became concerned, and I'm still kind of lukewarm on it in the intermediate term. But when I started to see signs of bottoming and maybe, especially the next, say, upcycle in terms of economic acceleration, I am still structurally bullish on copper long term. And I would echo Rick's views about Russia. And so that's been a challenging market because I've been investing in Russia for a few years. I like a lot of the companies there. And that was one of those things that was working out very, very well until the headlines about Ukraine. And so that's something that I've always managed the position size of carefully due to tail risks like that. And the way I would describe it now is that I'm not concerned about any of the companies. The only thing I'm concerned about is the tail risk of Americans being disallowed from owning some of those companies via sanctions and other things like that. And so I think you have to manage position sizes, but that I do think that especially if you start to see that conflict cools down and that some of those start to find, maybe kind of signs of a bottom, that is a very favorable market. You have in many cases very long life reserves, very low valuations, very strong balance sheets, and so I am favorable towards that. I've also warmed up to some of the Brazilian producers recently. It's not a market that I've been a big fan of. I'd be very cautious about position sizing, but I am getting somewhat kind of favorable on that directionally. And overall, I think that my approach is kind of across the board pretty favorable on commodities and just cautious on individual ones whenever they become particularly consensus, and I get back in when they're less loved.
What's the best way to invest in Russian stocks?
I mean, if you wanted to buy an ETF, there's RSX and ERUS. So there's two popular ways to do it. And then also, you can go directly to the Moscow Stock Exchange, or some of them have over-the-counter ADRs. It's not one of the easiest markets to own, but it is one of the cheapest. And if you look at, a lot of emerging markets, you have to be concerned about currency crises. So, for example, they have a lot of dollar-denominated debt relative to their reserves, whereas Russia is actually kind of the opposite. If you look at their macro situation, it's built like a fortress. They have very high reserves, they have very low debts, and mostly what you're dealing with is those political tail risks, sanction risks, headline risks, more than actual financial risks.
Got it. And when you said Brazilian producers, producers of what?
Oil, for example, and I'm pretty bullish overall on Brazilian equities, including some of their banking equities going forward. It's a very volatile, somewhat speculative view, but basically I kind of anticipate capital flows going into some of those markets over the next few years. And so I think we've seen some signs of stabilization. Basically, if over the past year, inflation in Brazil was going straight up. And they had to raise their interest rates from 2% to over 9%. So unlike developed market central banks, emerging market central banks had less leeway. They actually had to tighten considerably. And we're seeing signs that inflation in Brazil is topping out, which is actually similar to what happened back in 2016. And that was a very good bottoming buying opportunity for broad Brazilian equities. And so I think we're still early, right? So it's not something I would say, go all in on Brazil, for example. But I do think that as a diversifier, after a tough year last year, I've been pretty bullish on Brazil over the past, 2 to 4 weeks.
Okay. There's a question from the audience about a Brazilian company that I'm going to ask. But before getting into the questions, and I realize I've had you guys for almost an hour now, so I'm going to be quick. As you know, privateplacements.com. So, I can't not ask about private placements. Lyn, I want to start with you. I have a pretty good idea of Rick's position, but I will come to you as well, Rick. But Lyn, just your general take on private placements. Do you invest in them personally? Do you recommend any in your newsletter? What's your take on private placements?
Yeah, I personally leave those to, again, experts like Rick. They're outside of my circle of competence. And so ironically, I feel safer with Bitcoin than I feel with, say, some of those types of resource companies, because, those companies, actually, I talk to the industry leaders, I talk to the developers, I'm actually tied into that space, whereas I'm not very tied into some of the smaller natural resource plays. And so whenever people ask me about that, I defer them to experts such as Rick.
Okay, well, listen, you're a VIP with privateplacements.com now, so I'm going to make sure that you get all the PP data moving forward, and next time we talk, you'll be an expert as well. Rick, Rod just launched the Red PPLP, which is a Resource Exploration Development Private Placement Fund. Can you give us just your take on that as a shareholder, and just any new thoughts on PP investing, especially this year with some opportunities, perhaps?
Well, in terms of the Red LP, I need to disclaim the fact that, first of all, I'm the largest shareholder of Sprott and I'm on the board. I'm no longer an employee, but I'm certainly a beneficiary of any success that LP may enjoy. Two, all of the people behind that LP are my proteges, and I'm enormously proud of them and happy in their success. So let's get that out of the way. With regards to private placements, all of the money that I now invest sensibly, I made by speculating nonsensically in private placements. And so private placements holds a place near and dear to my heart, intelligently constructed private placements. I would echo Lyn's suggestion that if you, first of all, don't have access to specialized information or possess that information yourself, or if you aren't willing to work very, very, very hard in the absence of having access to that information, stay away from private placements. If you do have access to that information, and I would not so humbly suggest that in the mineral resource area, Sprott is probably the largest possessor of intellectual capital in the world around natural resource private placements, they're a wonderful place to be. I look back in my life to Paladin in 1999. Of course, I'm pulling out the best example in my 69-year space on Earth. But I remember doing a 10-cent private placement in Paladin with a 15-cent warrant and seeing the stock 7 years later, $10 bid. It's difficult to unveil against a speculative technique that occasionally exposes you to a share that goes from 10 cents to $10 in 7 years with a warrant. Now, I should caution people that before that stock went from 10 cents to $10, it went from 10 cents to 1 cent. So private placements can test both your financial and your intellectual fortitude. But if you are going to be in the speculative part of extractive industries, if you're going to be in the front end, if you're going to be in exploration, the idea that you don't participate in private placements, in particular, the idea that you don't allocate capital and get a warrant, which is to say extra upside with no downside, is stupid. If you are going to be in the space and you have the ability to access information, the private placement business is the best speculative technique in extractive industries.
You're preaching to the choir. Fully agree. I want to just quickly get to the questions here. So one for Lyn, one for Rick, and one for both. Lyn, what do you think of the Warren Buffett-held Brazilian fintech StoneCo, ticker symbol STNE? Would you buy it now?
So I think it's interesting after how much it sold off. I think it's worth watching to see for more signs of stabilization. It's kind of still a falling knife category. I'd be cautious about position sizing with a company like that. But I do think that it's an interesting speculation at current levels when looking out over the next 3 to 5 years.
Okay. Rick, question for you. And you've kind of already answered this, but there's a follow-up here. So have the uranium junior miners dropped low enough for you to start buying them? How much of the current downward uranium price pressure is due to the French reactor problems?
I began to re-enter my uranium positions last week. I will continue to scale in as long as they stay cheap. Wouldn't surprise me to see them go lower. There's no one more spiteful in the world than a jealous lover. And the people who were in the uranium space at the top 6 months ago are probably coming out of the space in disgust. So it wouldn't surprise me to see the prices go lower. I think the French adventure was effectively a non-event. If we had a real reactor problem, a Chernobyl problem, a 3 Mile Island problem, a Fukushima problem, that would be a very different set of circumstances. But I think that the wind is really in uranium's sails now. You've seen the EU suggest that uranium is a green fuel over, in particular, German objections. You've seen a sea change in public opinion in Japan with the Japanese people supporting the government's Kyoto Protocol pledges, which necessitates their use of nuclear power. I really think that the French circumstance is a non-issue. Now, listen, if you're going to be in any commodity sector, they are inherently volatile. And if you went into a broad basket of uranium equities without understanding that it would be easy to see a 25% decline in the index, you're in the wrong sector. It's just that from my point of view, you don't see sectors where the equity index has 250 or 300% upside for real reason, where you don't have the possibility of substantial downsides too. My life is all about juxtaposing the upside to the downside and talking about the probabilities around each, and then preparing myself mentally to suffer what might happen.
All right. Last question. This is for both of you. What would be the recommended ratio of physical metals to equities in the portfolio for an average middle-aged investor for the next decade? Why don't you, Lyn, start us off?
I think that partially depends on their conviction rather than just their age. Basically, how tolerant they are of volatility, and the advantage of the physical metals is that basically you have that kind of insurance type of aspect. It's outside the financial system. It's outside of custodial risk, things like that. Whereas when you're investing in the equities, you're making more of a speculation or investment on considerable upside. So it's less about insurance and more about a specific economic view or a specific company view. And so when you have the conditions favorable, I think you can ramp that up. If basically you have a catalyst and you're bullish, you could ramp that up to pretty considerable levels. On the other hand, if you look over the long run, say gold companies, for example, they underperform gold on average. You have some really good compounders, but mostly they do pro-cyclical investments. So they pour in capital when it's expensive. They basically mismanage cycle after cycle. And so I don't view them as necessarily great long-term holders, except maybe some of the royalty companies, maybe some of the really high quality ones where the management's really on point. But it's something I'd be more selective with when going into the equities and have a little bit more constricted time frame instead of just kind of say a 10-year holding period. I'd want to really be bullish over, say, a 3-year period, to consider holding this, at least some of those in size.
And for physical metals, there's something like the physical, like Sprott's Physical Trust. Does that work better for you?
No, I think those are very good positions because you have a spectrum. So, metals in your possession have one set of purposes. And then if you're going to use these public products, there's a range, right? So you have things like GLD that are very liquid, but there's questions around the quality of the custodian. Whereas with Sprott, you have a lot more assurances about the metal being there, and also just the overall quality of the company.
Got it. Rick, your thoughts, ratio of physical versus equities?
Investors always want one size fits all responses, and they're really impossible. It depends on the individual circumstance, both his or her financial staying power and their psychological staying power. As Lyn says, they're in a sense different asset classes. Physical gold or its surrogates, the ETFs or our trusts, are, I suspect, an insurance class, really. You are holding them because you are afraid of the ongoing purchasing power of your more conventionally oriented savings and investment assets. That's the way I own them, at least. One could argue that I myself don't need to own any gold because my life is so leveraged to the gold price through other investments. But the truth is, owning physical gold allows me to sleep nights and stay calm, things I value at my age. The gold stocks are very different. The gold stocks are ways that you can participate in management's ability to leverage value on increases in the gold price and their competitive advantages over other companies. And the ratio, I suspect, of gold to gold stocks in an individual portfolio has to do more with the ability of the individual investor to both assess and stomach the risks associated in owning precious metals companies. I would say too, if I might, that in terms of differentiating between the physical product and the various surrogates, including our own, that I have a couple of comments there. Physical possession is a good thing, but be very careful with it. I've known literally thousands of investors in my career who have engaged in what I call midnight gardening, which is to say storing their own gold at home. And I know several that have experienced a whole different set of risks, people coming to visit them who they wouldn't normally invite to lunch when they both had physical metals and they suggested to other people that they had physical precious metals. So be very careful. In terms of the differences too between the surrogate forms of precious metals, I own the Sprott products both because I trust the manager ourselves, but in particular because I'm a US taxpayer. And for certain advantages, for certain investors, pardon me, owning either physical gold or what the IRS views to be a direct surrogate, which is to say the ETFs, you are taxed on your sales proceeds if they exceed your cost at the collectibles or ordinary income tax rate, whereas for most taxpayers, any capital gains in the trust is taxed as a capital gain rather than as a collectible. As a patriotic American and as a sensible American, I try to pay as little tax as possible. I don't believe in feeding the beast, first of all, and I prefer to keep my money to myself. So with regards to the physical surrogates, I prefer our trusts as a US taxpayer.
That's great. Listen, that I think brings us to an end. Thank you so much. You're both very, very generous with your time. Please check out lynalden.com, ruleinvestmentmedia.com, privateplacements.com, and any questions or anything, send them an email. Don't be shy. Lyn, thank you very much. It was very nice to meet you. Rick, thank you. And that wraps things up. Thanks, everyone.
Arash, might I close with an offer?
Yes.
I'd love to talk to anybody who listened to this, and I'll give them an incentive to do it. If you go to my website, ruleinvestmentmedia.com, and list your natural resource stocks. Please no cryptos, send those to Lyn. Please no tech stocks, send those to Lyn. I'll rank your natural resource stocks 1 to 10, 1 being best, 10 being least best, if that's a polite phrase. And I'll comment on individual issues where I think my comments might have value. Once again, ruleinvestmentmedia.com. List your natural resource stocks only, please.
Perfect. Thank you very much, everyone. Have a great day.
Thank you.
Bye-bye.
Thank you.
Thanks, Lyn.